So first off, an interest rate is a cost of borrowing money, right? Or on the other side of the coin, it is the compensation for the service and risk of lending money. In both cases, it keeps the economy moving by encouraging people to borrow, to lend, and to spend. But prevailing interest rates are always changing, and different types of loans offer different interest rates. If you're a lender, a borrower, or both, it's important you understand the reason for these changes and differences. Now, whenever you go to take out a loan, or whenever a bank is giving a loan, what's being determined there is the riskiness of the borrower. Right? That's why they check things like FICO scores, right? Because they want to know how risky is this borrower? How risky is it to lend money to this individual? Or, when it comes to companies, how risky is it to lend to this company? And based on the riskiness of the loan, we know this because we know the individuals with higher credit scores tend to get lower interest rates on their loans because based on the credit worthiness, right? If you have higher credit worthiness, you should be able to borrow cheaper because it is more likely that you will repay the loan. There's a higher likelihood that you'll repay it. Therefore, they're not going to make you pay as much for that loan. But if your credit score is lower or you are found less credit worthy, then you will have to pay a higher interest rate. Right? That's just naturally how things go. Okay. Now, how are these interest rates determined in the first place? Yes, the more credit worthy, the lower the rate, whatever. But how do you determine base rates? How do you determine what the rate is going to be at any point in time? Well, interest rate levels are a factor of the supply and demand of credit. An increase in the demand for money or credit will raise interest rates, while a decrease in demand for credit will decrease them. Conversely, an increase in the supply of credit will reduce interest rates, while a decrease in the supply of credit will increase them. Okay, so we're in an extremely low interest rate environment right now, right? Historically low interest rate environment. That's why if anybody that's been looking for a home, they've gotten a record low interest rate on their mortgage, and this is simply because the supply of credit is extremely high. Right? The supply of money is extremely high. Now, how is the supply of money so extremely high? Well, the supply of money is high because we've had several stimulus packages, right? And that pushes money into the economy, right? Which circulates money in a very real way, right? And gets money moving through the economy. People are lending, people are borrowing, right? And that increases the supply of credit. Now, the question really is, why do we have such historically low interest rates right now? Because we are in a historically low interest rate environment. Why is that the case? Well, coming out of the Great Recession, 12 years ago, we had extremely low interest rates because during the Great Recession, nobody was lending, right? Nobody was able to borrow money, right? Everything was really illiquid in the markets, right? Money wasn't really flowing through the markets. And given that money wasn't flowing, then what the Federal Reserve did was they decreased the cost of borrowing in a very extreme way. They pumped money into the economy. They pumped money to the banks so they could borrow more and gave them more free rein to borrow, right? And that made people want to get out and actually borrow money and actually spend money on things. And it stimulated the economy in that way. And interest rates stayed low for several years, but we started to tick up interest rates right before the coronavirus pandemic, right? And so when the coronavirus pandemic occurred and there was an economic shutdown that was forced, right? We forced an economic shutdown upon ourselves. Then the federal funds rate dropped precipitously. The Fed decided to drop interest rates very precipitously because the economy was stopped. Right? And people needed to get their hands on money, and money needed to be as available as possible to individuals and businesses. And when that's the case, interest rates are extremely, extremely low. And so that's what we saw in that particular case. So it's no surprise, right, that now we're looking at a low interest rate environment, and people like the Treasury Secretary are talking about the possibility of raising rates in the future and whether or not that would be a bad thing or whether or not that would be a good thing, right? Now, the Fed chair today is Jerome Powell, right? And Fed Chair Powell says it is highly unlikely that the Fed will raise rates this year despite a stronger economy. He said that back in April, right? He's been very stuck on the idea of keeping rates low until the unemployment rate gets back to, near what it was before the pandemic. He said, quote, "I'm in a position to guarantee that the Fed will do everything we can to support the economy for as long as it takes to complete the recovery." And so that really leaves the completion of the recovery determination up to the Fed. and then who knows what other outside voices, whether it be the president or Congress or other political things, are speaking into that. But regardless, right, they hold the keys to interest rates, and they hold the keys to monetary policy. And the Fed, not only can they impact the interest rates, they can also change the supply of money in the economy. And the way that they've done this, most historically, right, whether it's the Great Recession or whether it is during the coronavirus pandemic, what they have done is they repurchase treasury bonds from the market, right? And when they do that, what happens? Well, that is basically them printing money, right? You ever hear printing money? That's what we're talking about. They print money in order to pay for those treasury bonds and then bring those treasury bonds onto their balance sheet. And so they're just holding or owning these treasury bonds, but the money for those bonds actually goes back into the market and can be actually lent to other individuals. Borrowers can actually get their hands on that money and it can stimulate the economy. But it increases the amount of money in the economy. And as you increase the amount of money in the economy starts to heat up. The economy starts to go in a very fast way, right? And this is where we start seeing these inflation scares. And we're kind of in a place now where a lot of people are worried about inflation because we pumped a lot of stimulus money into the economy, right? We have all of this bond repurchasing that we've done. There's been, the PPP loans. There's been all types of money that has gone into the economy for free, basically. And when that happens, then the cost of living is naturally going to rise. Because just think about this. Just think about if you have $100, right? We'll use very micro scales here, okay? If you have $100 and something costs $100, right? And so you would be willing to buy that thing for $100. But then the Federal Reserve came out and they said, okay, well, there's $100 in circulation right now. Let's increase that to $105. We're going to add $5 to circulation. Well, then what is the place of business or person who is selling you the thing for $100 going to do? They are going to increase the price of that thing to $105 because now $100, what was once worth $100, is now worth $105, right? But that $105 is less valuable than it was previously. Previously, you could buy more with $105 than you could at the time once the Fed had added money to the economy and increased the prices of goods and services indirectly via the amount of money that they had put into the system, right? So this is what we see when we see inflation. When we see inflation, we see the prices of goods and services rising, not because those things are more valuable now, but because the value of the money that you are using to purchase them is less valuable now. It has gone down. That value of money has gone down. Okay, so we have to keep in mind that even though supply and demand really push the interest rates over time, so does inflation, right? And if inflation gets too high and the prices of goods and services are increasing too rapidly, then what would be the natural course of action? The natural course of action would be to increase interest rates, right? And if you increase interest rates, what's that going to do? That's going to increase the cost of borrowing for both people and corporations. And if you increase the cost of borrowing and you cut all of these bond repurchase programs, you stop doing that, then what will end up happening naturally is that the economy will slow. Now, to what extent? That's the game. That's why the Fed is directed to do what they're supposed to do, and it's their job, right? Because it is a very tricky business in determining how much do we want to try to slow the economy, how much do we increase rates by, how much do we stop this stimulus into the economy, right? And so those are decisions that the Fed has to make, and a lot of people are pushing them to make some of these rate hikes because we're basically at 0% interest rates on the Fed funds rate, okay? And so people are pushing the Fed, hey, we should increase interest rates because if we don't, then we're going to have hyperinflation, which is dangerous, right? Because if you have hyperinflation, that means the cost of goods and services are increasing extremely fast, right? And if that were to be the case, then it's going to be difficult to go out and purchase things as individuals, and it's going to tank the economy ultimately, right? That's what hyperinflation has historically done, right? So that's what we don't want. And so when we talk about what Janet Yellen is saying here when she's talking about maybe, higher interest rates could be a potentially good thing. Well, she's saying that in lieu of the fact that they would pump more money into the economy. And she's saying, I don't think it'll have too big an impact on inflation. But if it does, maybe higher rates aren't that bad.